I would now like to request Mr. Sunil Singhania to host a moderated Q&A session. And I know a lot of question cards have already been floating around the room, and some have come through which have been handed over to Sunil. But I request if anybody has any questions, please hand them over to one of our volunteers up there and they'll reach to Sunil. Thanks with that word.
Thank you, Russell. For a while I thought that we would all go scared. But thankfully, you had a positive view on India and of course gold. And India is obviously a country which loves its gold. Just to pick up on your last comment, you mentioned about inflation. So you have always said that deflation is not good for the markets. Inflation obviously is good for the markets. So we'll be in a situation where there will be repression, but obviously because inflation is good, the markets might do well.
Yeah. So I think this is on, is it? Can you hear me? So I still think there'll be a deflation shock first, and that's bad for the markets. And I think if we just throw the term inflation away and call it declining cash flow, that's why it's so bad and so dangerous for the markets, because the cash flow can actually fall below interest expense. And as an equity owner, you don't own the assets anymore, they go to somebody else. That's the downside. When this thing happens, I think there'll be many people who will say, well, that's it, we'll never have inflation ever again. But I'm really convinced that the governments can create inflation, but central bankers can't. And it'll be a fiscal policy, and I've mentioned this to many people. Look, if tomorrow morning we woke up and the government of America had taken all the student debt onto the government balance sheet, I think we'll have high inflation. There's $1.4 trillion worth of debt, student debt, and if the students don't have $1.4 trillion of debt, they'll borrow $1.4 trillion. And they'll probably invest it in housing and cars, and they'll do it through the banks. So obviously for equities, Mr. Buffett is always right. Price is what you pay, value is what you get.
Right.
And if you have the deflation first, I think equities will get very cheap. And in my book, I look at why they get cheap and why they turn around. People expect deflation and they get inflation. And in this scenario, that's exactly what would happen. And just one other thing to throw into that. If China devalues the currency, everybody will scream deflation. And that is exactly what we'll get in the short run. But in the long run, we should actually get high inflation. China will be letting its exchange rate go to pursue a much easier monetary policy. And this will not be 94. In 94, China had huge amounts of excess labor, and it just didn't produce inflation. And I think this time, if China really gets aggressive in monetary policy, it'll produce lots of inflation. And the other thing I said in my book was that at the great bear market bottoms, there's a massive structural change. Now here's the biggest structural change that nobody in this room could foresee. The Fed fails to reflate the world, and the PBOC does it instead. Now what a shock for the world that would be.
Right.
But I think we need to think about that. So deflation first, equities cheap, but ultimately it will be inflation.
You did mention about US dollar strengthening, and you also mentioned buy gold. Don't you think there's some kind of a disconnect there?
Absolutely. So it is if we go back to the first 6 weeks of this year, we actually had a dollar that was stable to rising slightly and a gold price that was shooting up.
Right.
So we actually had this thing happening, and I think it confused many people, and people said, how on earth can you have a dollar rising and gold going up? And I think it's this reason. In any normal scenario, gold is a function of real rates of interest. And then there's abnormal scenarios. And the abnormal scenario is when what we're forecasting is massive government intervention, not to create growth, but government controls. And in the first 6 weeks of this year, people were genuinely concerned about a collapse of the financial system. They were saying the government's going to have to do something aggressive to deal with this. And in a situation which was inherently deflationary, if you look at the tips market, inflation expectations fell and fell and fell and fell, and gold went up and up and up and up, and you're scratching your head and going, how can the market be pricing in lower inflation and higher gold? It's because it's pricing in this action by government. And you've mentioned the Indians' affection for gold. Well, that's because you have a history of government intervention, whether it's capital controls or anything else. So your own history, I think, tells you how gold, obviously you've had inflation as well over that period, but to some extent your own history tells you why investors might favor gold in a period like the one I've described.
Okay. So, we have Brexit, which has caused a little bit of an issue, but not too much. Suppose if even one of the smaller Euro countries decide to, exit the euro, and obviously for the reasons which you mentioned that, if you have such a high debt to GDP, then someone will have to act. And with different economies of euro having different dynamics, the only way they could do is, one of the other countries, the weaker ones, maybe Greece or Finland or someone exiting the euro. Won't that be catastrophic?
Yeah, yes. I can give you a longer answer, but the simple answer is yes. But what I think we should, so the euro is very, very difficult. People ask me all the time, who will leave, who will stay? It's unforecastable. So I want to focus on the one thing that I think we could forecast in a situation like that. So let's say that the peoples of Europe want to renegotiate the euro for the reasons you've just discussed. This would have to be done in a democratic forum. The governments would have to meet, and it would probably have to be put to a referendum. And that would be a very public thing. And the markets would be ripping Europe apart. So I think the forecastable thing is, if Europe comes to a stage where it has to renegotiate that, and I strongly believe it does, the forecastable thing is they would impose exchange controls while they do it. And as a democratically elected government, it's not unreasonable. I think we're changing the whole constitution of Europe, and you can't do that with kind of a gun to your head. But, and it's a big but, it's a huge but, you've just deliquified the world's biggest asset class. European bonds and European equities are the world's biggest asset class, and they've just deliquified, and it could be another Lehman Brothers moment. So it's done for the best possible reasons to allow democracy to make an informed decision. But the repercussions for the financial system could be really gross. Now, what happens after that in terms of how Europe, we just can't forecast it. But I keep mentioning capital controls, and people, and I've been saying this, by the way, since the crisis began. And we have had capital controls in 3 developed world markets, Iceland, Cyprus, and Greece. 2 of those are in the single currency. So it is really not outrageous to think that we should all be considering what might happen in Europe if this has to be renegotiated.
You started with the presentation saying that, we are robbing the old people because they have been saving a lot. And obviously, with your suggestion of financial repression, technically there is no incentive for savings. There's a question, what would be your advice to savers from India?
Sorry, what would?
Your advice be to savers from India?
What advice would be
To
for
people who save in India.
In India. Well, I'm very hopeful that you won't have financial repression. I really think there's a real prospect of that. Now, in the short run, I'm very worried about Europe. I'm very worried about, so you have to be very, very cautious. And I personally, despite being one of those great long-term enthusiasts for India, never owned any Indian equities. I always struggle with the valuation. But if this comes to pass, equities will get significantly cheaper. My suggestion was, as long as you're convinced that India doesn't follow these policies, you should buy an awful lot of Indian equities.
And you did mention about capital, India being a capital deficient country. So in this world of financial repression, won't it be like a contagious kind of a thing where every country will get impacted?
Well, that's what I was hoping to get at. The initial impact of this will be very painful. But India really doesn't have to do it. But that doesn't mean to say it won't do it. Politicians faced with pain can do lots of very strange things. So I don't want to stand up here and say to India will not do that, because it's possible that it will. But we have to keep an open mind and say this India and some other emerging markets might not, and how exciting that would ultimately be.
This is a question which partly you have answered, but for the benefit of a specific answer, inflation is basically the end game. You have to get into inflation. Japan has tried it. It's not worked. Why do you think that in China or some of the other economies we will get into that stage?
Sure. Well, it has to be. So I think central banking isn't succeeding in that. So it has to involve the government. And I've mentioned forgiving student debt. I think that would be successful. So it is interesting. If I said the words fiscal policy and you close your eyes, you'll see a bridge. That's kind of what you do when you think of fiscal policy. But another fiscal policy would be to relieve the tax burden on young people. And it seems to me that because our policy to date has failed, we're pushing up the asset values of the old people. The young people, this is maybe not so true in India, but it's certainly true in the developed world. The young people are not getting wage growth. Anything that would push wealth to the young people, I think, would be inherently inflationary and would work. So another policy for Japan, where student debt's not an issue, we announce a policy in Japan that anybody with a child under the age of 10 pays no tax. I don't know who in this room has got children under the age of 10, but you're the people who really spend money. So there are things that we can do. Now that is funded, in a word, that is funded by the central bankers, and that creates a fiscal deficit. That's helicopter money.
Right.
That is helicopter money. I think it works. Now, so although I've been a deflationist since 2011, I believe that inflation would come down, and it has come down, but we haven't had deflation. I don't believe in the long run that we will get to inflation.
This is a question which is based on your CAPE and Q ratio. In what time S&P 500 will go below 10 times CAPE and Q ratio below 1?
Okay, well, I obviously thought that we'd be at 10 times CAPE a long time ago. I didn't think we'd be at this level. So, no, that isn't really what we run a whole course on. It takes 24 hours to teach it, so what can I say? Okay, let me put it this way. If you were to give me one variable, if I could know in the future one variable that would allow me to answer that question, it would be the inflation rate.
Okay.
And here's something I would say. If the inflation rate in our future is deflation, then the answer is very quickly. So if you think there's going to be deflation, and I think there is, then the answer is very quickly. If, however, the future shows us rising inflation, then actually it's historically happened very slowly. The two prolonged periods of mean reversion in the cyclically adjusted P are 1901 to 1921, 1966 to 1982. They happened against the background of rising inflation. And I think the moral of that story, we usually take 24 hours to tell this, but if the future holds a dramatic reassessment of the growth rate of earnings and dividends, stock market comes straight down. We saw that in 07, 09, we saw it in 2000, 2003, we saw it in 29, 32. But if actually it's a rising discount rate, the market is always behind the ball on that, and the PE comes down slowly. So I think it'll be deflation, and I think it'll happen quickly. And I've said that for 3 years, so one day it'll be right. But if you actually think it's going to be inflation, I think the cyclically adjusted PE will mean revert very slowly. It could take another 10 years. I hope that's not true, because I'm very keen to buy some.
And from a Japan perspective, there's a question whether hyperinflation is better or repression is better for Japan.
That's a great question. That public debt to GDP ratio is 220%, total 400%. I would make a radical forecast that the highest rate of inflation in the developed world for the next 20 years will be Japan. And people say it is impossible to create inflation in a country full of old people. Well, there's an easy way to create high inflation in a country full of old people, and that is convince them that the piece of paper in their hand doesn't have as much value as that table. And once you convince them that that table will hold value more than that piece of paper, then the velocity goes up. Well, we're a long way from that in Japan. We're a long way from that. You have to go through the foothills of inflation first. But it can be done, that even old people consider that physical goods are a better store of value than money. And with the debt to GDP ratio so high, I think Japan can get there quicker than anybody else.
Nice.
So I know it's an extreme forecast, but it seems to me that Japan is the country most likely to do that. There's something else I need to focus on actually in Japan while I'm talking about it. What is financial repression? It's forcing the saving system to own the bonds. Japan can't do that. It's the only developed world country that can't do that because it's already done it. The US and Europe, about 50% of the entire saving system's in government debt. In Japan, it's nearly 90%. Right. And there's another fundamental difference in Japan. The total amount of savings are shrinking. Their demography is further advanced than everybody else. So you have this system that's full of government debt, that's beginning to shrink, and the reason the Bank of Japan is buying government debt is they're running out of savings. The West is not running out of savings. It's got ample savings, just happen to be invested in equities, but as I suggested, they can do something about that. If you look back in history in a country that runs out of savings to fund its government, what happens next?
Yeah.
And that is where we are with Japan. So I feel strongly for these reasons that Japan will perhaps go beyond mere inflation into something higher. You have to remember, the word hyperinflation is bandied around a lot. It has a technical definition, which is monthly inflation over 50% per month. So, it may not get to that level of inflation, but I'd forecast it would have...
So we'll have a trillion yen note also,
Yeah,
right?
it won't get to that, but it would have the highest rate of inflation, I think, of the developed countries, but, hyperinflation perhaps not.
And you also happen to mention, and it's widely known that you do believe that high GDP growth does not necessarily mean equity returns. So, India is in that stage where GDP growth definitely looks, sustainable at 7-8% for a long period of time. What makes you confident that even equity returns can be high for India, if that is the view?
Yeah, well, I'm not 100% sure on that. It's not because of that. It's not because of the level of growth in India that I'm optimistic about India ultimately. It's because of structural issues in India, particularly because, unlike China, you have these private sector banks, which I happen to think are good banks. I look in the audience in case anybody laughs, because it's a good way for me to test whether you think they're good banks or not, but clearly China doesn't have any private sector banks. You're not an economy that's been over-reliant on exports, so I see fewer shocks to the Indian system. But the reason I hesitate is because I think the one thing all fund managers can do to get better is try to spend as much time forecasting the supply of capital as they do in looking at demand and GDP. And, you can have an economy that grows at very high levels for a very long period of time. You get no returns because the capital, physical capital, was coming on track. So that's classic China. There's some companies in China, they've been in the fastest growing economy in the world. There's some share prices that haven't gone up in 20 years because they added supply more rapidly. And that's because at the core they have that state-run banking system which finances all of that. And to be bullish as a capitalist on capital return, you have to look at a system that's becoming more capitalist. That's why I like India.
Right.
It's not because I think the equities are necessarily wonderful value today, but that direction of travel could become increasingly unique as the world progresses.
And you also did mention that in a scenario where there will be high inflation and low interest rate, asset owners or utilities would tend to do very, very well. So obviously, miners and oil companies. But at the same time, the view is that China would have massive issues. So what is the view on commodities and oil with respect to both these factors put together?
Yeah, well, I'm clearly trying to be too clever here and dividing it into two bits. There is a deflation shock. Clearly, oil and commodities don't do well in that. But as we move into this policy, then that is...
So you'll have first a big dip and then move up.
I showed, the very first slide showed global debt to GDP higher than 2007. All that says to me is fragility.
Right.
And I have to believe that, it's not triggered. And I look at so many triggers in the world to expose that fragility. And that gives you the big dip. Now, I could be wrong, and maybe this thing is somehow much more robust than I think it is. And that's why I would be wrong. But at this level of fragility, you have to expect things to get worse before they get better.
I'll just done with most of the questions are similar questions. Just one question from my side. You have always cited limitations of monetary policy, and you have said that once the central bank runs out of options, they go to the government. And the term also policy singularity you have advocated a lot. Do you think it's going to happen soon?
Yeah, I think what we all need to do is get Bernanke's famous helicopter speech. So in the helicopter speech, which was in 2002, I think November 2002, when we still had inflation, Bernanke had to give us a list of things that central bankers could do to stop deflation. First obvious point is they subsequently failed. But you can actually print it off and you can put a line through everything they've already done. Yeah. And then when you get to the end, what you see is this: the next thing has to involve the government. It actually isn't a central bank policy acting in isolation. It has to involve the government. Now, there's a problem with that. Governments are not like central bankers. They're not proactive, they're reactive. And to get the government involved in this, even in Japan, is actually proving a bit difficult to get that final step. How much more difficult in a country like, or a continent like Europe, where there's complete political paralysis? How much more difficult in the United States, where the president, whoever she may be, probably...
So you believe it will be a she?
Well, whoever the president might be is very unlikely to control the House of Representatives. So the analogy I like to make is with 2008. Let's say I came to you as a strategist and said, hey, the US economy is slowing. Bear Stearns has gone bust on the 17th of March 2008. There's a massive fiscal expenditure coming, and you've really got to get involved in the stock market today. And then what happens? Stock market falls 45%, and then you get the massive fiscal expenditure because the politicians needed the political capital to react. So running through Bernanke's playlist, we've kind of got to the stage where you need the government. My view would be they'd probably need a crisis to focus their mind on doing what, let's face it, is an incredibly radical thing to do, this helicopter money. So that's another reason for being, say there's something comes first, to get the politicians engaged. And that's when everybody has to rush out and buy Anatomy of the Bear.
One last question.
Looks at the bottom and why it turns around.
One last question before we wind. The global equity markets have been on an upswing, at least in the recent past. What are the one or two things which would make this rise in the global markets continue for at least some time?
Yeah. So I think the number one thing where I could be wrong would be that we did get a global coordinated fiscal response. Now, the one I would particularly point to is actually not America, but it's Europe. I think the great positive surprise for markets would be if Mrs. Merkel endorsed fiscal expansion for the whole of Europe, not for Germany. Germany needs it, but there are austerity fiscal constraints on the rest of Europe, which are just part of the problem that's pulling it apart. And as a last gasp effort to hold Europe together, she might just say, well, everybody can have much bigger fiscal deficits, and that will be funded by the European Central Bank, and I think that would be a huge surprise. It could create longer-term problems, particularly for her in Germany, but would really be a great big positive for the stock market. In monetary policy, the most important thing would happen is nothing to do with the central bankers, but our commercial bankers in America, Europe, and the United Kingdom, and then Japan, suddenly they start lending aggressively. Suddenly that loan growth picks up and money supply growth picks up. And no, I can only think of two.
No, great. I think there were a couple of questions addressed to me. What is the view on equity markets in India? I think Russell has already said that India stands out, so equity market on India is pretty good. And there was one question, why are hedge funds not allowed in India? I think the regulator is opening up the Indian economy slowly, and through the AIF route, more and more products are allowed in India. So I think, we have had the pleasure of speaking to Russell. Thanks a lot, Russell.
Thank you.
Also, the bottom line is very clear that the world is obviously, leveraged a lot in terms of the debt to GDP. And as Russell has always been advocating, there's a financial repression which is going to come. It might come after a year, after 2 years, but it's definitely going to come. But amidst all this, there will be few pockets of opportunity, gold, and luckily for us, Indian equities. I think we really appreciate Russell. We are running out of time. I think they're all hungry on a Monday evening, but Russell hopefully is here with us for some more time. And I'll hand over to Anil to do the honors for the closing.
Sure. Thanks a lot, Sunil and Russell. Thanks a lot. Really appreciate that. I think before I just request for a formal vote of thanks, and I'll just like to conclude by saying that, of course, Russell also has been very kind and supportive to us even in the past. Last I remember was in the annual India Investment Conference, and that just reminds me to put forth a point and perspective to all our participants out here that January 13th, 2017 this time is the date, so please block your calendars. For both the guests, of course, as a CF Society India, you will have started getting the mailers, but otherwise I'm very sure and confident that like past years, even Reliance Mutual Fund this year will be a strong supporter of the India Investment Conference, so please watch out for the date, that January 13th, 2017. And we will bring to you a host of marquee speakers like Russell out here. And with that, I'd just like to now request Jayesh to please come on stage and give a brief vote of thanks as a formal note from our side. Jayesh Gandhi, as most of us know over here, needs no introduction. He is the current president of the CFA Society of India. As a part of his day job, Jayesh is a senior fund manager at Birla Sun Life Mutual Fund, and he's been an astute investor in equity markets since the past about 20 odd years. With that, I'd just like to request Jayesh to come on board and propose a formal vote of thanks. And along with that, I would like to, please Jayesh. I'd also like to request Jayesh and Sunil if they can just offer a small memento of token of appreciation to Russell for kindly being with us over here.
Yes,
And
thank you very
Santosh
much.
Chandra
Thank you.
for the
Is this the Kohinoor? Thank you.
It's the Kohinoor.
It's a Kohinoor.
Yeah, it is the Kohinoor.
Thank you.
Good evening, friends. I know I'm between you guys and dinner, but few word of thank you. First of all, thank you, Russell. Thank you for coming here again. We are really excited about your plans in India and the course that you are running in India and the thoughts that you can do it on an annual basis. The Indian investment professionals are really excited about this. I'm sure there's a lot of demand, and as our organization, as CFA Society India, we would offer our support, and we look forward to you doing this course in India again and again, and that gives us an opportunity to have you here in India again and again. So thank you very much for that. Friends, Russell has been one of our more favorite international speakers. This is the third time that he's speaking to us, and we do expect him to come here more. So I thought this venue and this event today as being the best opportunity for me to offer him a honorary membership of CFA Society India.
Wow. Thank you.
We hope you accept that.
I'm delighted to accept that.
Wonderful, great. Also, an opportunity to thank Reliance Mutual Fund and Sunil Singhania. Sunil is, of course, a long-time supporter, and so has been Reliance Mutual Fund. We really thank them as well for supporting our events. Friends, thank you very much for taking this time on Monday evening, coming and joining us. Please do join us for dinner and refreshment, and of course, Russell for some interactive sessions or informal discussion. Thank you very much.